Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My guest today is Callie Cox. Callie is an investment analyst over at eToro. She always has some really interesting market stats to share, so it's going to be a good one. And as a reminder, this is for educational purposes only, and nothing Callie or I say here should be taken as investment advice. Anyways, before we talk to Callie, it's Friday, the markets are closed, so let's take a quick look at how this week played out. All right, so the market ended the week on an ugly note. All four major indices closed lower on the week. The Russell 2000 led, but it still fell about 3% this week. The NASDAQ lagged, dropping a little over 4.5%. Now, last week we talked a lot about the June highs and how they were going to be really important to watch this week. And with today's big drop, we're back below those June highs in the S&P 500. You also have this bearish head and shoulders pattern here, and the neckline coincides with those June highs. So this is a pretty bearish look for stocks in the near term. Now, taking a look at the sectors of the S&P 500, only one of them closed higher, and that was, of course, energy. It led by a wide margin, gaining a little more than 4%. Tech was the laggard on the week, dropping about 5.5%. Now, my next guest has a lot to say about the stock market and the economy. And just a reminder, we pre-recorded this conversation yesterday before today's big drop. But either way, let's hear what Callie has to say. All right, Callie, thank you for joining us today. How are you?
Doing great. Thanks for having me, Patrick. Really excited to be here.
Yeah, absolutely. So I know you're always saying you're not a technician, but a lot of your work focuses on the technicals and stats too. So we're going to go ahead and make you an honorary technician for the day. How's that sound?
Oh my gosh, I'm honored. I have so many technician idols out there, so I'm really happy to be a technician for the day. Can't talk head and shoulders though. Can't talk head and shoulders or any crazy patterns.
Yeah, there's a whole bunch of patterns with funny names and all that. But before we get into market stuff, could you just tell us a little bit more about your role at eToro?
Yeah, sure. So I'm technically the U.S. investment analyst at eToro, which basically means I get paid to talk about markets. But realistically, I talk about markets and I work them into different business lines we have. I'm one of the public-facing people at eToro. Having the privilege to step out there and talk to our customers and other retail investors about what retail investors care the most about, markets and the economy in their language and in an accessible language. At the same time, I work as a bit of a consultant to other business lines within eToro, talking about how to weave our market insights through customer connections, through internal projects we have, through products we're releasing. So it's a really fun job. I've been there for about 6 months, and eToro has an awesome offering. Lots of cool things coming in the next year that we can't wait to show everybody.
Yeah, and you and I don't know each other that well, but I had Ryan Dietrich on the show a couple weeks ago, and I brought up your name, and he was like, Callie, I hired her back in the day when I was at LPL, and I guess you were a Bloomberg reporter before that, right? And then you went to work for LPL under Ryan, which shows because I think a lot of your stats and your style of analysis is very similar to his.
Yeah, so Patrick, we know each other really well. Online friends count. I've been a mutual admirer of Patrick's for years, so it's great to finally get on the mic with you. And yeah, I come from the Ryan Dietrich School of Market Analysis. I was doing a bit of it prior to meeting him. It's funny, he was a source of mine at Bloomberg, so we've been friends basically since I started out in finance. But I did come down to LPL. I worked for Ryan. That was my first, I guess, legitimate real stint in research. Was working as a senior analyst with him and a few other members of the research team there. And he taught me a lot of Excel tricks, a lot of really cool ways to communicate ideas. And I think the world of him. He's great.
Yeah, Ryan is a great friend of the Chart Report and just a overall great guy. But let's get right into it. So I want to start off with a stat that you shared recently. And there's been a lot of talk about the 200-day moving average. Of course, we failed on that initial attempt last week to reclaim it. We kind of kissed it and then just got rejected. But we're still within striking distance, and really, we could reclaim it as soon as like next week, right? So as buyers and sellers kind of battle it out near the 200-day, the big question on everyone's mind is still, are we in a new bull market, or is this just a bear market rally? And the stat you shared here attempts to answer that question. So what do you think? And just tell us a little bit more about this stat.
Ooh, we're starting off with a spicy question. I like it. So that's a question I get a lot these days, and I'll preface everything with, I don't have a crystal ball. I don't do predictions or forecasts. It's probably better off for everybody that we don't focus too much on forecasts, because your own portfolio and nobody knows where the market is going. But I love to dig into the data and understand why markets move the way they do, especially compared to history, because Ryan Dietrich actually says this a lot. History doesn't repeat, but it often rhymes. That's
Mark Twain originally said it,
Mark
I believe.
Yeah. Yeah. So, I love digging into how markets have reacted to things in the past, because you can find some really interesting parallels there. And it all boils down to the fact that, markets are kind of a psychological case, if you will. We're all looking at the lines, we're looking at the headlines, we're trying to figure out how our portfolio will react to certain things, but our emotions are working into it as well. We're all psychological beings, and a lot of times our emotions take over our logic. So I attribute a lot of what I look at to that. The fact that sometimes we psych ourselves out and we tend to make moves based on, how the market is trending that day. So everything I talk about in this interview will probably go back to that.
Yeah, no. So I want to get back to the question, but you're right. I mean, that's the cool thing about technicals is it is the study of the behavior of market participants, right, and how they behave in certain situations. So let's get back to the 200-day here. What is this stat you brought for us?
Yeah, I promise I'm not dodging the question. I'll talk about it. So when I was, of course, I'm watching this recovery, the big question is it going to last? Are we going to make it back up to new highs? Is this going to be a V-shaped recovery? And there was a stat that was thrown out there about 50% retracement levels. I think that was Jonathan Krinsky's stat. So it got me thinking, especially because this market has been almost magnetized toward the moving averages. When I say this market, I mean the S&P 500. And the 200-day, probably the biggest technical line of them all, was coming up pretty quickly. So I thought about looking into past bear markets, and if the 200-day was a signal of sorts for if certain rallies were bear market rallies, or if they really were that pushback to new highs. And looking at all of the bear markets since 1950, I believe that there are 10 of them, 11 of them. There are a lot of them, n equals 10 or 11-ish. We actually haven't seen many bear market rallies that have exceeded the 200-day moving average in the S&P 500. And when I say that, I'm talking about, so when the S&P falls about 20% or 20% or more, but then markets kind of regain their footing and they rebound, we typically don't see that actual bull market recovery until that bull market recovery crosses the 200-day. So you see a lot of instances where we get rallies, but then they tend to pause just below or right at the 200-day. They don't cross it, and then they fall back down, which is essentially what we saw a few days ago, I believe last week. So it's interesting,
it was Tuesday, right? I think.
Yeah, Tuesday. It's really interesting. And I don't look at one point in isolation. I can't say like this is happening, so of course it's a bear market rally. But I think it's a really interesting question to ask because I don't know, obviously I don't know what the future holds, but I think it's going to take a lot for this market to reach the bottoms again. But that being said, I think it's going to take a lot for markets to reach the highs again as well. We're in a high inflationary environment. We're still sussing out exactly what collateral damage rate hikes and inflation have caused. We're seeing a lot of interesting trends in leadership right now. It feels like a very unsettling time. And, markets can rally in unsettling times. We've learned that a lot. But at the same time, the Fed doesn't have that impetus to let markets make it back to new highs. And talking before Jackson Hole, this seems to be like right in focus with what markets are thinking about these days. So It might take a lot for us to get back down to the bottoms. We might have to see some deterioration in earnings. We might have to see some deterioration in the job market. But what pushes us higher, what gets us back to new highs, I'm not so sure yet. So really long answer to your question, Patrick. I don't know.
No, and that's
I
quite
hope
all
it's the
right.
bull market recovery.
I think sometimes I don't know is the intelligent answer. And I like what you said there about how you don't focus on one isolated data point. It's more of like, we call it a weight of the evidence kind of approach, right? And we had that 50% retracement, right? We got over the 50% retracement, that stat that John Krinsky brought up. So, starting to look like more of a new bull market from that stat, right? But this one, we haven't achieved it yet, right? We haven't broke above the 200-day yet. But if we did, to you, that would be further evidence that we maybe are in a new bull market. Is that right?
I think so. And I think it's also significant that we've crossed the 50-day, we've crossed the 100-day. We have these floors below us too. If anything, they could cause investors to pause and think twice and say, okay, where's the market trading relative to what I expect in the future? So, again, not a technician, although I am an honorary technician for the day.
You are an honorary technician.
I am. I feel like, the floors are coming in, and psychologically we may be getting the mojo back in the markets. And I think part of that, and I know we'll talk about this later, is the fact that the market's mood was just so sour at the beginning of this year. We kind of just expected everything to be horrible. And now that it's horrible, but not worst case scenario, we're breathing a little bit.
Yeah, I mean, that really leads us right into the next question, or the next topic, which is sentiment. And I think it's interesting that, when we got rejected, call it a week ago, at the 200-day moving average, it's almost like bearish sentiment came right back, right? And the bears came out of hibernation. And I think that's kind of what you want to see on a pullback. Those bears just coming out all of a sudden again. And it's kind of a reminder that we're coming from a place of excessive optimism, or excessive pessimism. I mean, really extreme bearish sentiment that we haven't seen since, the financial crisis and other really prolonged bear markets. So let's get right into sentiment next. You call this one the hype cycle. I've been seeing a lot of charts like it. This is your version of it, but there's a ton out there. We've all seen that famous anatomy of a bubble chart and kind of the emotions that go with it. I think Justin Mamis, he's a technician that has also done a lot of work on this sort of sentiment cycle. And for, I think, a lot of new investors out there, this is probably the first time they're experiencing this emotional roller coaster, right? And, so often emotions kind of are the opposite of what's profitable, right? You get euphoria at the peak and then absolute despair at the bottom. So they say nothing changes sentiment like price. Where do you think we are in the hype cycle right now?
Well, I want to tell a quick story about this hype cycle, Jeff. So I was explaining just what you explained to my content and marketing team at eToro, which, by the way, greatest group of people to work with. They're so creative. And one of them actually made this chart here, something I could have never done. But, in explaining, when you have an investor, when you have a new investor, explaining emotions and the opportunity and risk during emotional times is kind of a tough thing to process. It's almost the opposite of how your brain works. And if I talk about risk aversion, if you get close to a really hot stove and you're about to touch a really hot stove, your brain is screaming at you to stop. And of course, you touch the hot stove and you're like, ouch, that hurts. I'm never doing that again. The market is almost the opposite. And you can see that in these anatomy of a bubble hype cycle charts. The stove is really hot. Things don't feel great right now. But over time, the best investments that you can make in terms of cash flows and return have been in bear markets. There's so much data that backs that up. So I like what you said, Patrick, about fear too, because there's been just excessive fear in the markets all throughout this year. And it's for a good reason too. We're in the middle of a pretty aggressive Fed rate hike cycle. We're looking at, historically high inflation. We obviously had the Russia-Ukraine invasion earlier this year, which was kind of a very unfortunate and awful event, but also one of those unpredictable events where we're kind of watching the second and third order effects come out. And we haven't really, the mood has improved somewhat, but we haven't really gotten back to, even a happy state, if I classify it that way. We're almost back to like that skeptical state where we're kind of creeping back into the market, but we're like, oh, I'm ready to jump back out if I see one little headline. So, I look at the hype cycle, I look at this, this GIF we created, and it's hard to point out exactly where we'd be, but, I don't think we're near the top. I really don't think so. If you think about where we were in 2021, the wild days of 2021, everything going up. If you look back to how the tech bubble looked, this is just night and day. And I think a lot of this fear is because we came from a pretty high point on the hype cycle, and every growthy asset just got crushed so quickly over the past several months. So it's
early 2021, you saw that speculative fever. That was the euphoria, kind of, is what you're saying, right?
Yeah, that was the euphoria. And, honestly, I think it's going to be really tough to get back to those kind of euphoric highs anytime soon, because investors have felt a lot of pain, especially in certain areas and certain pockets of the market, tech and crypto being the obvious ones there. And it's also, that's also a really good point in looking at this market, thinking about how hard tech and crypto and then other sectors like consumer discretionary, for example, thinking about how hard other sectors got hit. Those are the sectors that are leading us higher. And risk does tend to rebound the quickest when you're coming out of like a pretty nasty bull market. History can show us that. But at the same time, it's hard to see exactly what the collateral damage is in those sectors thus far, because they are the growthy sectors, and we could be in this high inflation environment for a while. That's a really tough environment to operate and raise capital in for a small speculative company. And now the mood is really sour. So I think that's a bit of the disconnect that we're kind of working through here. It's like, there's a lot of fear, risk is rallying, this doesn't quite match up, especially because we don't expect conditions to improve significantly anytime soon. So there's a lot of cognitive dissonance going on.
Yeah, it almost seems like we're kind of in that disbelief phase where, we're up double digits off the lows, something like 17%, and yet, you still see a lot of concern out there, and some of it probably is legitimate, but that doesn't mean the market can't continue higher, and that disbelief turns into relief and then optimism, and that's how the cycle goes, right?
Yeah, I'm telling you though, fear can be such a healthy dynamic for markets. It's when you tense up your stomach expecting a punch, and then the punch happens and you breathe, you're like, wow, that didn't hurt as hard as I thought it would. Of course, because you tense your stomach up. That's how I explain it, and it doesn't feel great, but of all the things that have gone wrong with this market, sentiment, I feel like, is just still so far on the bullish side.
You mean bearish side, right? Which is bullish, right?
Yes, exactly. It's still so fearful, but that can be a bullish thing.
Right. So I want to move on to this next chart. We used this for chart of the day about a month ago or so, maybe 2 months. And I got to tell you, the folks loved it. I don't think we've gotten that much engagement on a chart of the day like that in quite some time. So first off, great chart. And, recession talk has died down a little in the past couple weeks. Maybe it is because we are up double digits off those lows. And I think it's amazing how much time gets wasted talking about, are we in a recession or not? Right? Because does it really matter at the end of the day? The S&P 500 prices are probably going to, sniff out a recession or sniff out bad news and price it in before it's apparent to the public, right?
Yeah, so this is a very important theme to remember. It was especially important around the time we made this chart. I think it was a few days before Q2 GDP came out, and there was this big debate on social media going on. Are we going to see that second negative print in GDP? If we do, are we in a recession? And then you have one camp saying, yes, that's what I learned in my textbooks growing up. Then the other camp saying, no, there's actually this council called the NBER that labels it a recession. Ultimately, it's all semantics, right? The economy is in a really tough spot right now. It doesn't feel good. No matter if it's in recession or not, it doesn't feel good. But for this instance, we're going to talk about it. We're going to talk about it in a more than semantics kind of way. And this chart came about because, I was talking to a few people, and I really believe that the stock market has factored in a lot of what we've seen so far. You can be surprised by the rally all you want, but we have that bearish sentiment and we have that decline because the stock market was expecting some pretty nasty things ahead, and it ended up we hit all of them. So I thought it was really important to show our clients that when you look at the stock market, it's not necessarily an accurate representation of the economy. And there are two ways to look at that too. Number one, literally the stock market is not the economy. The stock market, if you look at the S&P, about 42% of the S&P is service-based businesses. But services businesses, I'm talking about hairdressers, I'm talking about restaurants, I'm talking about doctors, stuff like that. About 70% of the economy is made up of services activity. So in other words, that burrito place that you love going to down the street, it's probably not publicly traded, right? Like that would be silly. You'd laugh at me if I suggested that. But that's why the stock market isn't the economy. You don't have those small businesses factored into how the stock market is moving. So that's a really important point here, especially as we talk about the rotation from goods to services spending, talking about like how you spent all your money on TVs and exercise bikes at the beginning of the pandemic, and now you're spending your money on flying and eating out and seeing your friends. But it's also an important point in just understanding how the stock market moves with the economy. And there's kind of an inception-y theme here as well, because generally the stock market moves on expectations of the future. There's a saying out there, I can't think of it off the top of my head. Yeah, forget it. I had a brain fart.
I mean, we saw that during COVID, right? I mean, I don't think it was ever so apparent than during COVID when I think it was probably April or May when we were up double digits, kind of off the lows, kind of similar to where we are now. And the whole world was shut down, right? And people could not understand how we just had this massive, maybe 20% rally when the whole world is at a pause, right? So that, to me, was probably the best example of it. But I think the data you found here is very interesting, that essentially you're saying the S&P 500 peaks 6 months before the start of a recession, right? And then it bottoms 3 months before the end of a recession, right?
Yeah, so to make this chart, I looked at all bear markets or all big drops in recessions since 1950. And I basically just looked at when the drop started, when the drop ended, and then when the recession started, or when the NBER said it started versus when the NBER said it ended. And in almost all of the cases you look at, the stock market starts dropping before the recession actually starts, which seems a little backwards. You'd think that the stock market would respond to, painful conditions or, less spending, stuff like that. But the stock market does a pretty good job of anticipating that. And that's a really important theme as we think ahead to all these trends that are moving in a better direction, but also thinking about how the world just feels really, really uncomfortable. So, this chart was all about portraying that, how the stock market moves in relation to how the economy moves. And I think this is especially important too in the age of pretty rampant, information kind of analysis paralysis, if you will. More information than you'll ever need in social media, because the market is digesting all these things at warp speed. We get a Powell press conference, 40,000 people are watching it on YouTube. The market reflects that so quickly. And the market is almost expecting what Jay Powell will say based on like little vibes and like tingling every in a bunch of different markets. But it's really important to understand, especially here, because if you're looking at economic data, if you're looking at where inflation is going, if you're looking at the GDP number, chances are the market's already factored that in, and it's kind of moving on. The market has a mind of its own.
Yeah, and so I want to get into that because I know you look at the economic data and Fed policy a lot closer than I do. As technicians, we really just care about the market's reaction to all that data rather than the data itself. So I wanted to get your perspective on it. A lot in the same way that recession talk has cooled down, so has the talk about inflation lately. So what do you think? Do you think inflation has peaked?
Well, I said inflation peaked 3 months ago, so I'm gonna call myself out on that one. I sure hope inflation has peaked because it's been super, super painful. And I think a lot of different prices and a lot of different commodities we look at do point to the fact that inflation has peaked. Demand is coming down. Hopefully we see that work its way into more services prices, like the price of airplane tickets, like the price of medical costs, the price of insurance, the price of rent. Hopefully we see lower demand, kind of work into that a little. It's a little bit stickier, but I feel like we're definitely seeing it on the goods and commodities side. We're seeing oil drop off. Oil is the big one. Food inflation, we're seeing some pretty positive signs that it could come down soon, although it hasn't officially come down yet. We're seeing the price of TVs. We're seeing the price of exercise bikes get slashed, and retailers stepping out and saying that they have way too much inventory. So I'm hopeful that inflation has peaked. It doesn't necessarily mean the Fed's job is done, because the Fed is surely not satisfied with 8.5% year-over-year inflation. That's way too high. But we're moving in the right direction. And I think that's part of the reason why we've seen markets rally a little bit, because markets care about the trend. You and I hate the level. We hate the fact that we're paying more for our grocery bills, but markets are paying attention to that change in trend. And the slowing inflation trade is a trade that naturally goes back into growth and risk.
Yeah, and I realize that's a little bit of an unfair question. If you could predict inflation, you'd probably be working at the Fed, or maybe the chair of the Fed, right?
That'd be Jay Powell.
Yeah, right. Wouldn't that be interesting?
But that's one of the big questions of these days too. Like, it's a hard question, but it's one of the hard questions we have to face.
Right.
And as an investor too, like, you could know the trends in inflation, but the most important part is paying attention to what it means for your portfolio, because you might know that a slowing inflation trade means a rally in growth and risk, but are you holding those? Are they suitable for you? Do they fit your goals? That's something you need to take into account too.
Yeah, so all this sounds pretty optimistic and bullish, right? So let me ask you, what do you think some of the biggest risks or concerns are out there right now?
Ooh, the what keeps me up at night question.
I mean, obviously inflation, we just talked about that, but other than inflation?
Yeah, there are a bunch of boxes you could tick for this one. The biggest one on my mind right now is just how investors will be able to process a U-shaped recovery. The kind of 2 steps forward, 1 step back kind of recovery that a lot of us are expecting in the market, because we're in a high inflationary environment that is kind of fundamentally broken at the moment. So that's the big one that we're talking to our clients about. Obviously we want our customers to feel empowered to do what's best for them, but we also want to prepare them for, the harsh reality that could be ahead. The worst case scenario is if we break that bottom, if we see this bear market go lower, that's looking less probable in our minds. But what the situation looks like right now is kind of a slow grind higher, and not as quick of a recovery in some of those growthier and riskier assets that a lot of retail investors piled into. And that can be a tough environment in itself. I mean, if you're somebody who holds a lot of growth and a lot of your names were down 50 to 80%, if they rebound a little bit, you're still down. You could still be down 50 to 60%. That's not a fun time. And a lot of these growth and risk assets do take a lot of time to blossom. The story takes a lot of time to blossom. The concepts take time to blossom. And we just hit a really big rift. So I worry a lot about, how investors will process this recovery and how they'll survive it. And the flip side of that is it's kind of a blessing in disguise too, because we haven't had a moment in time since the great financial crisis when markets have been significantly down for a while. They've always V-upped back to the highs. So there are pros and there are cons to it, but we're just really trying to tell investors what to expect from here on out and preparing them for the fact that it may not look like recoveries they've seen in the past. Other things that worry me, I think a lot about deglobalization. Deglobalization meaning, we saw all these supply chains break. We saw the fact that we, couldn't rely on one of the biggest commodity exporters on the globe. How do those trends manifest themselves in companies and the markets? There's a lot of good, but I think there are a lot of unintended consequences that we're going to run across. And, nailing down those unintended consequences are for bigger brains than mine. But, I think a lot about these big shifts that have happened because of COVID and because of the Ukraine invasion and how they're going to impact society as we know it.
Yeah, I think that's a really good point about some of those growthier areas. I don't want to mention any single names in there, but some of those heavily owned growthier tech stocks were down 60, 70%. And I think that's a really good point that, to expect just a V-shaped recovery to all-time highs from some of those areas of the market is probably unrealistic. And if we do recover, it's probably going to be more of a process than sort of an event, right? So what is that going to look like, and how are investors going to handle that, I think is a really legitimate concern and valid question.
Yeah, and I'll add too, not all tech companies and not all crypto projects and protocols are going to make it through this. We've already seen some that have had to slash a lot of jobs. We've already seen some fail. And with the amount of just ground shifting beneath us, there's a chance we see more of that. And that could be a stock or a coin that you're invested in. So I think preparing investors for that as well, things that you invest in may not even survive this, is a really tough reality to grasp.
Yeah. Well, Callie, I think that's all the time we have for today. But before we go, if people are interested, where can they follow more of your work?
Yeah, definitely. Well, first of all, thanks for having me, Patrick. It's been so fun to be here. If you want to follow me on Twitter, I'm at Callie A Bost, Callie A Bost. That's my handle. My team's handle is eToro US, eToro US. They tweet out some pretty fire content, so give them a follow, give them a shout out. They'll answer back. They're great. And I write a weekly note called the Bottom Line. I publish it on my Twitter, but if you want to read it, you can go to eToro's blog. And Patrick, I'm going to have to find the URL for you because quite honestly, I can't remember.
That's quite all right. Thank you so much for coming on the show and sharing your perspective. I think you gave us a ton of food for thought here. And yeah, we'll have to do it again sometime.
Yeah, this was fun. Thanks.
Awesome. Well, have a great weekend. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.